Bull markets can seem like they're going to come down at any moment. And if we're currently in a bull market and you're thinking about investing, then maybe you have wondered about waiting to see if the market is going to crash and then you can get started with investing. But here in this video today, we're going to talk about why you should still invest even if we're experiencing a bull market. And we're also going to define exactly what a bull market is and why it's a great opportunity to get started investing or to continue investing if you already have been investing this entire time. Let's first start by defining what a bull market is, because it's important that we're all on the same page here. When we are experiencing a bull market, it's generally known as, having a strong economy, having high investor confidence, having, low unemployment, and having high corporate profits. That's just a general term for having an overall, good market. But more specifically, putting some numbers on it, a bull market is when the market experiences a 20% or more increase since coming from a declining market. So let's say that we were in a recession and the market was down. If it happened to have come up by at least 20% or more, then generally many people would consider that to be a bull market, especially if it has remained at that level for at least 2 months. But one thing you might be wondering is, why is it called a bull market in the first place? Well, simply put, it is called a bull market because when a bull uses its horns, it's going to swipe up. So when the bull swipes up with its horns, that references the stock market also going up. And that is why a bull market is seen as a more positive thing, with high investor confidence, and because the market is up, at least 20%. So now that we're all on the same page, we can talk about why a bull market is a great opportunity to get started investing or to continue investing. But before I go into that, I just want to say really quick, if you're enjoying this video so far, please give it a like, hit that like button. It really helps me out and I really do appreciate it. While at the same time, consider subscribing to the channel because on Cashflow, this channel is putting out new videos every single week. Currently, I'm doing Tuesdays and Fridays at 8 a.m. Pacific Standard Time, and we talk about all kinds of things related to investing, saving money, and just growing your net worth in general. But let's move on to the bull markets. The most recent, historical bull market that I like to reference is right after the Great Recession. So the Great Recession took place between 2007 and 2009, also known as like the real estate crash. But during that time, after 2009, the market has been rising and we had our longest economic expansion in history until more recently when something else happened that you might know about ended that economic expansion. But basically from 2009 up until I would say 2020, we had the longest economic expansion in US history. So that just means that the markets were on a very upward trend. And so that was a really long bull market, as you can say, because the market was up way more than 20% from its lows during the Great Recession. And before that, another significant bull market that we experienced was after stagflation. Stagflation is basically where you have inflation and you have stagnant. So you have high unemployment and you have a declining GDP. So prices are increasing while people maybe losing jobs, can't find work, and the overall gross domestic product is declining. So that happened around in the 80s, and right after that, shortly after that, they did have an economic expansion and they did experience a bull market after stagflation was finally ended, because stagflation is a terrible thing for a country or an economy to go through, but we did have that happen in the 80s. So now that we've talked about what a bull market is and some recent ones that we've experienced, at least in the United States, we can talk about maybe what kind of strategy should you have if you're considering investing, but currently we're experiencing a bull market. Well, if that is the case, one really good strategy that you can do is just called dollar cost averaging, where you continually invest, a certain amount of money in a certain periodic amount of time. Let's say if you get paid, twice a month, then you invest into the market maybe twice a month as well, or you can just do it once a month, whatever your preference may be. But you set a general amount of money that you're going to invest aside. Say you're going to invest $1,000 a month. Then you would invest, say, $500 on the 1st and another $500 on the 15th. Or if you want to, you could just invest $1,000 on the 1st of every single month. But you do those periodic investments over a set time period. That allows you to buy shares of whatever you're buying, whatever the price may be. So you're going to get a best average price. So, that day, the stock or the bond or the index fund, whatever you are buying at that time, it might have a price right here. It might have a price, a little bit lower. It might have a price down all the way down here, or it might be all the way up here. It doesn't matter, because what happens is over time you get the best price, you get an average price. of all those prices. You know, if you paid $30 for one share one day and you paid $25 of one share one day and you pay $20 again for another day, you know, your average price should be $25. You know, even though one of those times you actually did pay $30 for it. And the reason why this strategy actually, you know, does work in many circumstances is because you cannot time the market. You know, even if we are experiencing a bull market, you know, where the market is up 20% and you're maybe down in the dumps and say, well, dang, I could have gotten it at cheaper, you know, when it was during this time, it was 20% less than what it is now, because now we're experiencing a bull market. But you can't beat yourself about that, because no one can accurately predict, you know, every single time when the market is going to make, you know, drastic moves, when it's going to go down 20% or when it's going to go up 20%. But we can know that the market is going to fluctuate. And so we can use that to our advantage by utilizing dollar cost averaging and just consistently investing, you know, over a long period of time. And then the best odds that we have is to get that average price, because that average price is probably going to be a pretty good price compared to if you were completely trying to time the market. You have to be correct, you know, twice. You have to be correct when the market is high, so you are not buying and you are selling, and you have to be correct when the market is at its low, when you are considering buying instead of selling. And so it is very difficult to time the market because no one knows where the market is going to go. And sometimes the market can fluctuate in ways that many people do not expect. No matter how much you study the market, no matter how much experience you have, you know, analyzing it, no one knows where it is going, and that's why continually investing, even if it is a bull market, can be a great investment strategy. So that is why you should invest in a bull market, or at least consider it, because market timing just simply doesn't work. Even the so-called experts are not able to time the market correctly, you know, consistently. And you and me as individual investors, we probably have an even smaller likelihood of succeeding in that game. But one thing we can control and one thing we can do is we can dollar cost average our way to getting the average price of the highs and the lows, and therefore coming out pretty well on top. And that is why on this channel, on Cashflow, we are a high proponent of index fund investing, more specifically broad-based index fund investing, you know, investing in the entire US stock market, investing in the entire international stock market, investing in the entire US bond market, and such things like that, because we are using dollar cost averaging, we are getting the best average price, and we are consistently investing over long periods of time. And if you look back and create scenarios of, you know, hypotheticals, if someone were to invest X amount of money over a long period of time, you can see that it has worked. And most likely it will work again in the future. Even if, you know, historic returns are not an indicator for future returns, there is a high likelihood that you will still get a positive return on your investment as long as the world economies continue to advance. And if you want to continue your journey to learning more about becoming a master of your cash flow and growing your net worth and becoming a better investor, then before you leave, make sure that you watch this video if you haven't already. It is about how to achieve financial independence in 10 years. It is basically a blueprint to growing your net worth and becoming a master of your own personal cash flow. Thank you so much for watching this video. I'm Zach from uncashflow.com, and I hope to see you next time.